Hey everyone, and welcome back. Now, I'm sure there are many people who clicked on this video and are probably thinking, what kind of scammy bullshit is this kid about to try and sell me over the next 10 minutes? And to be fair, I would be thinking the exact same thing if I had never heard of what an investment arbitrage is. But essentially, there was a situation that occurred in the markets with one of the stocks that I was invested in that allowed me to make about $1,200 in the space of a week while taking zero risk. And the first thing that I should say is that this isn't something that you can go out and replicate every single day or every single week in the markets. And in fact, this one event, is the one and only time that I've had an opportunity to make a zero risk trade throughout this entire year. What I'm about to show you is a rare occurrence. You may never even see one of these through your investing experience over the next couple of years. However, I think it is a good lesson to share my experience with what I did so that if you do come across this in the future, you can take advantage of it, because they don't happen very often, but they can be very lucrative if you do identify them. And as I said, this is an arbitrage, which I'll explain throughout the video, but it is essentially a zero risk trade. There was no risk associated with a gain that I made on this investment. So with that said, let's just jump straight into the details of what happened with this particular stock, which is Corporate Travel Management in this circumstance, and how I was able to go about structuring this trade to access an investment arbitrage. So the first thing that I want to talk about is what was the event that created this opportunity. And in this circumstance for Corporate Travel Management, it was that they are a travel business that was looking to make an acquisition of another smaller travel business. I initially invested into Corporate Travel Management in February and March of this year because I was looking for a business in the struggling travel sector that was in a superior position, was a business that was not struggling, was not burning a ton of money, and that was actually in a financial position to take advantage of the current climate, which is that a lot of travel businesses are struggling, and the strong businesses like a Corporate Travel Management, for example, can acquire good businesses that have found themselves in weak financial positions. And that opportunity for Corporate Travel Management happened in September and October of this year, where they announced that they were acquiring a US company called Travel and Transport for about $275 million. And the way that the company was funding this acquisition was through issuing more shares, selling more shares to existing shareholders. So this acquisition essentially gave existing shareholders, people who already owned the stock, an opportunity to buy more stock in the company. But more interesting than that, it also created a unique arbitrage opportunity in the stock market. An arbitrage is the action of taking advantage of the price difference of an asset on two different markets. So essentially being able to buy an asset and sell that same asset for two different prices at the same time. Now, most of the time you can't do this, right? If you're going to buy Facebook shares on the US market, there's just one price, right? You unless you're doing some kind of private sale, you're not able to buy and sell at the same time, the same stock, but at different prices. But in this circumstance, there was an opportunity. A new market was created when the company was directly selling new shares for a different price to the market price, the price on the Australian Stock Exchange. Early in September, the company announced that existing shareholders could buy an additional 1 share for every 4.03 shares that they held on October 1st. And these shares could be purchased at a price of $13.85. And on October 1st, the share price for Corporate Travel Management was $17.30, and thus an arbitrage opportunity was created. So essentially what happened was on October 1st, Corporate Travel Management was recording which shareholders held which amount of shares. And on that day, they recorded that I held a certain amount of shares. And what that meant was after that had been recorded, I no longer needed to hold the shares in order to be eligible for investing in these new cheaper shares at $13.85. So on that day, I was able to sell stock at a higher price than I was going to be buying them back in the same week. So it's not as if I had to buy the stock at $13.85 and then hope that the stock price would be higher in the future so that I could sell it. I was selling the stock first and then buying it back, which meant I was locking in the sale price at around $17. I'll get into specifics in just a second. And then I was also locking in that I was buying them back at a low price of $13.85. So that week I sold 382 shares at $17.16 each for a total of $6,554.68. I of course had to pay brokerage on top of that, and I did this in a number of different trades. So the total gain, including brokerage fees, so net of brokerage fees, over the entire week was $6,514.78. That same week, I applied to buy 382 shares, the same amount that I had sold, from Corporate Travel Management at a price of $13.85 each, which would come to a total of $5,290.70. So what that meant was, at the same time, on two different markets, one on the ASX and one dealing directly with corporate travel because of this acquisition, at the same time I could sell stock at $17.16 or something about that and buy it back at the same time on a different market at a far lower cost. And the result was that I was able to make a pre-tax gain of about $1,200. The exact amount is $1,224.08. Now, pre-tax is the key word there, so we can't just stop at looking the difference between the price I bought and sold between those two different markets. We also have to account for the fact that when I did sell that chunk of stock initially, I had to pay capital gains tax on it, and that is going to be a significant influencer on what is the overall outcome of this arbitrage opportunity. And I think the important thing to understand here is that I'm not paying tax on the difference between the shares I bought and sold during that week. I'm actually paying capital gains tax between the price that I sold those shares for that week, which was about $17, and between the price I bought them initially back in February and March, which was a far lower price than the price that I was dealing with them in that week. So the capital gains tax was not going to be like 20 or 30% of the gain that I made in that arbitrage. It was actually going to be substantially higher, and this is a really important calculation that you need to be making before you attempt this opportunity, because as I'll show you in a second, for some people, doing this arbitrage would have actually lost you money depending on what tax rate you're paying. But the main tax that we're dealing with here is capital gains tax. It's the difference between the price that I bought those shares initially and the price that I'm selling them at. And capital gains tax will be different in every single country. So I can't possibly explain to you what this would have looked like for every person. I can only explain what it looked like for me. So in Australia, we have capital gains tax, which is taxed at your income tax rate. So basically, you take the capital gain and add it to your taxable income and then pay personal tax on that. And the only other sort of rule around capital gains tax is if you hold an investment for more than 12 months, then you only pay tax on 50% of the gain. So you get a 50% discount on the capital gains tax. Now, in this circumstance, I did not hold the investment for more than 12 months. So I was paying capital gains tax on the entire gain that I made from March until about September or October, it actually was. And in this circumstance, it was a substantial gain because the stock had been up so much. The capital gain on those shares that I sold, the 382 shares, was a total of $2,782.96. So that essentially means that I need to add $2,700 to my taxable income in the 2020-2021 financial year. So what does that mean? Well, it means that the tax that you have to pay on this arbitrage will vary from person to person based on a couple of different things. First of all, the time that you purchase the stock, because if I had held that stock for 12 months, my tax would have been far less. The other thing that matters is the price that you actually pay for those shares, right? I bought them quite a while ago, so I was paying a big gain because the stock had gone up so much. But if you had just bought the shares recently, the difference between your buy and sell, the gain, your capital gain, would have been far smaller. And then the final thing that matters is your personal income, because that will influence how much tax you're paying on that capital gain. In Australia, for example, if you make more than $180,000, then you would be in the top tax bracket, paying 45% on any gains above $180,000. And in that circumstance, this particular gain in my circumstance, if I was in that bracket, would have been tax of $1,252.33. So that basically means that in that circumstance, the entire gain would be erased by the effect of tax. But on the other side of the coin, if you were making less than $18,000, which is our tax-free threshold in Australia, then you would be paying no capital gains on this trade. And then there are other circumstances that I kind of fit into. So if you run a company, if you have some kind of discretionary trust set up, then there's a little bit more flexibility in the way that you can distribute money to yourself and to a holding company in order to reduce your tax. So depending on which kind of situation you fit into, the arbitrage will have a different outcome for you. A different amount of tax will need to be paid on that capital gain, and that will obviously impact the overall return that you generate from it. So by no means am I showing you this video to say that you could have done exactly what I did. Everyone who was attempting this arbitrage in this circumstance would have had a different outcome. They would have bought the stock at a different time. They would have paid a different price for the stock. They would have different income levels that would impact the amount of tax that they're paying on that capital gain. So by no means could you have replicated this exactly, and by no means can you replicate this exactly for other opportunities in the future. But these are the things that you need to think about if you are going to be attempting this in the future, maybe when a company that you're invested in wants to make an acquisition and is issuing shares at a lower price than the market price. Now, of course, I don't know exactly what my personal taxable income will be in the 2020-21 financial year, but I can make an estimate of what I would expect to pay on that capital gain. And in my circumstance, it's approximately $834.89. So that would leave me with a net after-tax profit or gain on this arbitrage of about $389.19, which equates to about $1 per share, a little bit over $1 per share for the portion of shares that I was using in this arbitrage. And on a percentage basis, it's an instant gain of about 7.4%. Now, for the last part of this video, I want to talk about some of the limitations of an investment arbitrage and some of the limitations that I experienced in this circumstance specifically. And we already spoke about capital gains tax and how that can impact the difference in results between person to person. So that's kind of one of the limitations, is just kind of the personal circumstances you happen to be in with that stock. If I had not held the stock since March, if I had bought it more recently, then I would have had a far greater gain from that transaction. But there are some other limitations that are important to talk about as well. The first is that this opportunity only occurred because the shares were being sold exclusively to pre-existing shareholders, okay? If Corporate Travel Management had come out and said, hey, we're selling new shares to the public, anybody can access them, and you can buy them for $13.85, then the market price of Corporate Travel stock on the ASX would have instantly dropped after the record date to $13.85. And why would that be the case? Well, why on earth would you pay more than $13.85 on the public market when you could just go directly to Corporate Travel and buy them for far cheaper, right? So if this was a public offering, there would be no two different markets for you to have that arbitrage. The reason why in this circumstance there was two different markets is because you did have two markets. One is the ASX, which is a public market, and the other market was Corporate Travel selling directly to only existing shareholders. The second limitation is that I applied to get shares, but it was never a certainty that I was going to be able to get every single share that I wanted, right? The company is just raising capital and they're just looking for applications from existing shareholders and from institutions. And if they had received more money than they wanted, then I would have maybe only gotten back, only been been able to buy 300 shares instead of 382. Or maybe I would only be able to buy 190 shares. So there was a chance that I wouldn't be able to buy all of the shares at the low price. And if that had happened, I would have had to buy back the rest, assuming I wanted to maintain the same number of shares. I would have had to buy back the rest at the public price, which I had no idea if it would be far higher or far lower or just similar in the future. And the last limitation is that after the record day where I had to have been holding the stock, it was very possible that the stock price on the ASX would collapse partially or all the way down to 1385. I actually thought this is what would happen. I thought that there would be a rush of investors buying the stock so that they could get access to the cheapest shares, so that they would be buying the stock before October 1st. And then after the date, they would have done what I did, which is they sold the stock. That didn't end up happening. The stock actually held up. So I had a couple of days to be able to to be able to sell shares at that higher price. But it was entirely possible that the price would have fallen down after the record date, and that would have either reduced or completely eliminated the arbitrage opportunity. So that is basically what I was able to do in October in order to reduce the cost basis for one of my significant investments. I hope you guys enjoyed this and I hope you got some value out of it. And if you have any questions, if there's anything you still don't understand, then make sure you head down to the comment section and let me know down there. I'll be happy to answer any questions that people have and of course receive some feedback and see if anyone else was able to take advantage of this with corporate travel management or with any other company in the past. But other than that, I hope you guys enjoyed today's video. Leave a like if you did and hit subscribe, of course, if you want to join the team and get updated every time that I am posting. But other than that, I hope you guys have a great day and I'll see you in the next video.